The week's first major catalyst came from geopolitics. Reports suggested that the United States and Iran had moved toward a framework that could reduce proxy conflict and create a basis for future nuclear negotiations. Markets reacted immediately. Brent crude, which had previously climbed close to $126 because of supply risk fears, dropped sharply. In one session, it fell by around 11% and moved below the psychologically important $100 level. This was not just an oil market event. Oil is one of the most important input costs in the global economy. When oil falls quickly, the impact travels through transportation, logistics, manufacturing, aviation, retail, and eventually inflation expectations. The market was not necessarily pricing in permanent peace. That is an important distinction. What the market was pricing in was the immediate economic effect of lower oil prices. When energy costs fall, companies see relief in transportation and production costs, margins can improve, inflation expectations can cool, and central banks gain more room to maintain restrictive policy without pushing the economy too hard toward recession. This is why the oil move mattered so much. It created a deflationary shock at exactly the moment when global central banks were trying to balance inflation control with economic stability. In other words, cheaper oil gave policymakers breathing room. For the Federal Reserve, this matters directly. The Fed has been trying to cool inflation without crushing demand. That balance is difficult. Raise rates too much and the economy weakens. Cut too early and inflation can return. But falling oil prices change the equation. If energy-driven inflation pressures ease, the Fed does not need to rush into another rate hike. At the same time, it does not need to cut prematurely.